let's get right into it. Today, we're cracking open the strategic guide to non-dilutive capital. We're talking about the absolute most powerful way to fund your startup in 2026. And here's the kicker. You get to do it without sacrificing a single ounce of your vision, your control, or your hard-earned equity. So what if I told you that you could score $350,000 to build your startup right now and keep 100% of your company? I know. It sounds like one of those late-night infomercials, literally too good to be true. But I promise you, this is the reality of the 2026 non-dilutive funding landscape. If you know exactly where to look and how to structure your applications, there are massive pools of capital just waiting for the right founders to build the future. So let's break down what we actually mean here. Think of your startup's equity as a freshly baked pie. Traditional venture capital, well, they take a massive slice of that pie before it's even out of the oven. But non-dilutive capital is essentially the government, a tech giant, or a specialized fellowship handing you free premium ingredients to bake your pie and then letting you keep the whole thing. It extends your operational runway, validates your tech, and leaves you completely equity-free. Okay, Section 1, the infrastructure layer, microgrants and cloud credits. This layer is where developers and really early-stage founders usually need the most immediate help, just to turn a prototype into a living, breathing product, without going broke on server costs. Let's start small, $1,000. Now, it doesn't sound like a fortune, but at the idea stage, it is everything. Programs like the 1517 Fund's Medici Grant are designed for folks they lovingly call creative weirdos. They aren't looking for some 50-page business plan. If you're building sci-level innovations, they will literally send this $1,000 directly to your Venmo, no strings attached, just rapid, high-conviction cash to get you building today. But then you swing to the exact opposite end of the spectrum, and you see staggering numbers like this, $350,000. That's what Google's Cloud Program AI tier is currently offering in massive compute credits specifically for AI-first startups. And it gets better, because it actually unlocks access to DeepMind research and Gemini model experts. If you're a startup burning through compute to train and fine-tune your proprietary models, this is a total game changer. When you compare the diverse options at this layer, the contrast is pretty wild. On one hand, you've got Vercel giving you $3,600 to power the front end of open source projects, making sure your UI deployments are buttery smooth. On the other hand, Google is essentially bankrolling massive backend AI infrastructure. So depending on whether you're rendering dynamic user interfaces or training large language models, there is a specialized credit program tailored exactly to your stack. Moving right along to Section 2, Elite Fellowships for Innovators. What if you aren't just writing code, but you're actually building hard tech in the physical or biological sciences? Software is fast, sure, but science is slow. You need serious patient capital to survive those brutally long R&D cycles without going bankrupt. Enter Elite Fellowships. These operate in a completely different universe than VC. Traditional venture capital demands rapid, explosive returns, and they take a chunk of your equity to justify the risk. But programs like the Activate Fellowship, they'll literally give scientist founders a $100,000 living stipend, plus another $100,000 dedicated R&D budget. You keep full control of your intellectual property, and you get the time you actually need to perfect the tech in a lab. The freedom to get stuff done. That's the core philosophy driving this whole space. I mean, look at the Theo Fellowship. They famously hand $200,000 to brilliant builders under 22 who drop out of college to chase their vision. Or check out the Astera residency out in California. They pay high-agency scientists up to $250,000 a year, alongside up to $1.5 million in project budgets, just to build open-source public commons projects. It's an entirely different paradigm of funding innovation that prioritizes human flourishing over immediate profit. Which brings us to Section 3. India's massive grant ecosystem. If we really want to see how non-dilutive capital can shift global innovation on a macro scale, we have to talk about South Asia. Check out this number, 9,400 crore rupees. To put that in perspective, that is over 1.1 billion US dollars. This staggering figure represents the Indian government's dedicated grant ecosystem. And they aren't just tossing money at another food delivery app, they are intentionally transitioning their startup ecosystem into a global hub for resilient, high-barrier deep tech innovation. The way they actually achieve this is through an incredibly smart, tiered funding ladder. India's central schemes de-risk ventures at every single step of the journey. Need to validate an MVP? The Startup India Seed Fund gives you up to 20 lakhs. Building a physical prototype? Needy Prayas has you covered. Advancing AI or robotics? Tide 2.0 steps in. And if you're tackling massive translational industrial R&D, the Technology Development Program can deploy up to 10 crores. It's literally built to carry you safely across the valley of death before private investors ever need to step foot in the room. But here's the really crucial point. It's not just the central government pulling the strings. Decentralized state grants are pushing this localized innovation even further. You've got Karnataka's Elevate program offering up to 50 lakhs for early-stage proof of concepts. Tamil Nadu has a highly targeted 10 crore space tech fund. This creates these incredibly specialized regional advantages, making certain states absolute magnets for specific types of cutting-edge startups. But of course, there's a catch. Section 4, Surviving the Liquidity Trap. Okay, so there's all this money out there globally. Problem solved, right? Well, not quite, because securing the grant approval is actually only half the battle. Now you have to survive the structural bottlenecks of institutional bureaucracy. I call this the grant liquidity trap. Imagine this, month 1, your grant is officially approved, you pop some champagne. But by month 3, your internal cash is completely depleted because many of these deep tech grants require mandatory matching funds. You literally have to spend your own money to unlock the grant money. By month 5, the government audit verifying your milestone gets delayed, and by month 6, you are in a massive existential cash flow crisis. It's a mirage where the money is technically yours, but verification delays leave you dying of thirst before you ever reach the oasis. So, how do we avoid that? Let's get into Section 5, Winning Your Non-Dilutive Capital. You absolutely do not want your startup to become a casualty of paperwork. Smart founders know how to mitigate these bureaucratic hurdles to actually win and deploy this capital effectively. You have to treat grants as illiquid assets that require cash to unlock. Step 1, model your burn rate rigorously. Just assume the government check will be late, because it probably will be. Step 2, negotiate phased terms with your vendors. Tell them straight up, they get paid when the grant tranche actually clears. And step 3, secure patient capital or soft debt. Bridge loans are incredibly common and honestly necessary to get you through that painful gap between hitting a technical milestone and actually seeing those funds hit your bank account. Finally, before you even worry about cash flow, you have to actually get a seat at the table. To survive the very first screening, you absolutely must avoid the amateur pitfalls that lead to instant rejection. In India, for example, you have to secure your DPIIT government recognition first. Across the board, globally, you have to prove your intellectual property is genuinely net new. Make sure your legal and tax documentation is absolutely flawless. And please never, ever try to pass off a reconstructed old business as a brand new startup just to grab some grant money. Evaluators will spot it a mile away and you'll be permanently blacklisted. At the end of the day, non-dilutive capital is the ultimate cheat code for the modern founder. It preserves your equity, it validates your technology, and it builds a massive moat around your business long before VCs ever get to take a look. So ask yourself, are you building your startup's kingdom on your own land, or are you just renting space from venture capitalists? Take control of your company's future by mastering these non-dilutive funds. If you'd like a deeper dive into this topic, check out the detailed article linked in the description below. Keep building, stay focused, and I'll see you next time.